Hello and welcome to KLM Institute.
Today, we're diving deep into the intriguing dynamics of the Indian rupee's performance against the US dollar, its record low value, and what it means for India and the global economy. We'll explore the factors influencing the rupee's decline, the role of central banks, and provide a broader perspective on currency fluctuations and their economic impact. If you're interested in understanding the global currency market and how it affects your daily life, you're in the right place. So, let's get started. The Indian rupee's recent record low. The Indian rupee has recently hit a record low, reaching 85.10 against the US dollar. This marks a significant moment in India's economic landscape, as the rupee has been under intense pressure due to a series of external and internal factors. Let's first understand the key reasons behind this sharp depreciation of the rupee. A major driving force behind the rupee's decline is the US dollar's strength. The US dollar surged after stronger than expected economic data from the US. For instance, the U.S. economy grew more than anticipated during the July-October period, and weekly jobless claims dropped significantly. This positive economic data reinforced expectations that the U.S. Federal Reserve would continue its hawkish stance, meaning they would maintain higher interest rates to combat persistent inflation. As a result, the U.S. dollar strengthened against most currencies, including the Indian rupee. This situation is made even worse by India's economic challenges. India's economic growth has slowed to a 7-quarter low, signaling a reduction in domestic economic activity. On top of that, India's trade deficit continues to widen, putting further pressure on the rupee. A higher trade deficit means that the country is importing more than it is exporting, which increases the demand for foreign currency and weakens the value of the rupee. The situation was further exacerbated on December 21, 2024, when foreign investors sold off nearly $500 million worth of Indian stocks, further increasing demand for dollars and contributing to the rupee's decline. Despite these pressures, the Reserve Bank of India (RBI) intervened in the foreign exchange market to curb the rupee's slide. State-run banks, likely acting on behalf of the RBI, were observed selling US dollars to stabilize the rupee. This intervention helped cap the rupee's losses to a certain extent, but the overall trend remained bearish. Analysts predict that the rupee may find some support around the 84.70 level, although the risk of further depreciation remains high, potentially reaching 85.50 if the economic conditions don't improve. Understanding currency fluctuations. Now that we've covered the factors affecting the rupee's decline, let's take a moment to understand why currencies fluctuate in the first place. At the core, currency values are determined by the demand and supply of that currency. Similar to any product or service in an economy, when demand for a currency increases, its value appreciates. Conversely, when demand decreases, the currency depreciates. Several factors can affect the demand and supply of a currency. A country's export performance is crucial. If exports rise, the foreign demand for the country's currency increases, strengthening it. On the other hand, if a country imports more than it exports, it faces a higher demand for foreign currencies, leading to a weaker domestic currency. This is what we are seeing with India's widening trade deficit, which has been a key contributor to the rupee's weakening. Central banks also play a significant role in the value of a currency. The Reserve Bank of India (RBI) regularly intervenes in the foreign exchange market to ensure stability. These interventions can involve buying or selling foreign currencies to control the rupee's value. If the RBI wants to prevent excessive depreciation, it may sell US dollars from its reserves to stabilize the rupee. However, if the RBI decides to devalue the rupee intentionally, it can make Indian exports cheaper, which could help stimulate economic growth. Devaluation and its impact. Speaking of devaluation, it's important to understand what this means and why central banks sometimes devalue a currency. Currency devaluation is when a country's central bank reduces the value of its currency relative to others. The aim is often to make the country's exports cheaper and more competitive in the international market. This can help stimulate economic growth by boosting exports and improving the trade balance. However, devaluation comes with consequences. It can lead to inflation because the cost of imports increases. For instance, a weaker rupee makes goods like oil and other imported products more expensive, driving up domestic prices. This could reduce consumers' purchasing power and create higher inflation. Additionally, currency devaluation can trigger a domino effect, prompting other countries to devalue their own currencies to maintain competitive positions in global trade. This is particularly true for countries heavily dependent on exports. If one nation devalues its currency, others may follow suit to avoid losing out in the global market. The role of political figures in currency debate. The Indian rupee's recent performance has also sparked a political debate. Congress leader Supriya Shrinate took to social media to criticize the government, accusing it of mismanagement in handling the country's economic situation. She argued that the currency of a country falls where the government is immoral and corrupt, pointing out that the decline in the rupee reflects poorly on the government's credibility. She suggested that the Prime Minister's reputation is closely tied to the rupee's performance and that the currency's continued depreciation erodes his dignity and credibility. On the other hand, some government officials argue that the rupee's decline is largely due to global economic factors, including rising U.S. interest rates and slowing global growth. They also emphasize the RBI's role in mitigating the rupee's volatility, suggesting that the Indian government is doing what it can to stabilize the currency despite the external pressures. The recovery of the rupee on December 21, 2024. Despite the pessimistic outlook, the rupee experienced a brief recovery on December 21, 2024, appreciating to 84.95 against the US dollar. This uptick was a result of RBI intervention and market adjustments. Investors and analysts are closely watching the upcoming U.S. inflation data, particularly the Core Personal Consumption Expenditure (PCE) price index, which will provide further insights into the Federal Reserve's future actions. If inflation data shows a slight rise, it could continue to fuel the dollar's strength, potentially leading to more volatility in the rupee. What does this mean for you? The falling rupee has widespread implications for various sectors of the economy. If you're a consumer, expect higher prices for imported goods, especially fuel. The rise in inflation could reduce your purchasing power and increase your cost of living. For investors, the weakening rupee brings uncertainty, especially for those involved in the stock market. Capital outflows from foreign investors have already impacted Indian equities, adding to the volatility. However, if you're looking to invest in foreign assets or foreign currencies, the weaker rupee could offer a window of opportunity to purchase dollars or other currencies at a more favorable rate. A historical perspective on money and currency exchange. To understand how currencies like the rupee fluctuate, it's important to take a historical look at the evolution of money. The concept of currency exchange dates back thousands of years, with trade conducted via barter systems or using commodity money such as gold and silver. The modern system of exchange rates began taking shape in the 19th century with the establishment of the gold standard. This was followed by the adoption of fiat currencies in the 20th century. In today's world, exchange rates are often determined by a mix of market forces and government policies, with central banks playing a significant role in managing currency values. The concept of floating exchange rates, where currencies fluctuate based on supply and demand, emerged after the collapse of the Bretton Woods system in 1971. Final thoughts. The Indian rupee's performance against the US dollar is a reflection of complex economic forces. Whether it's the strength of the US economy, India's trade deficit, or the policies of the Reserve Bank of India, the rupee's value is shaped by a range of factors. While the RBI's interventions have provided some relief, the rupee's long-term trajectory will depend on both domestic and global economic developments. As we continue to monitor the situation, remember that currency fluctuations have a ripple effect that impacts everything from inflation to investment opportunities. Stay tuned to KLM Institute for more in-depth analysis on the global economy and financial markets. Thanks for joining us today, and don't forget to like, share, and subscribe to stay updated on the latest economic trends and insights.